Good evening, ladies and gents. I'm very excited to be able to present this multi-let deal to you this evening. We believe it's a good deal. We believe we're going to make it work, and everyone is going to make profit from this one. So yes, let's get to it. It's quite a detailed presentation. Some of the slides are going to be very data intensive, but I'm going to try and give you the most important points and the most interesting snippets from the deal as we go through. Let's see. Right, here we go. Just as a reminder, what Profusion is all about. We're about bringing together brilliant minds, innovative, wealth-driven individuals to realize the common goal of building and preserving wealth in the Western Cape property sector. What a mouthful, eh? While empowering the individual property investor through education, paired with a powerhouse of industry specialists ready to help you grow. So on that education note, that is why this presentation is so jam-packed. I guess I could have told you about this deal maybe in 3 slides, and you would have had the very basics of it. But just by looking at all the aspects that we're going to cover, you can learn in terms of all the different aspects that a property investor, I almost want to say, should. If you really want to cover all the bases, you should look at all these elements when evaluating a deal. Right. So this is definitely some jam-packed education coming up. Right. So in terms of the executive summary, so as we said, this is a multi-let opportunity available for a joint venture partnership, in the sense of we are going to cover three main partners who are joining in a joint venture. Right. So the one partner is the capital investment partner, and we want to say that is Profusion Stokvel. If we can raise all the capital within the Stokvel, then the Stokvel will be the sole capital investment partner. Right. The capital we're looking for is 560,000. The deal is going to pay interest on that capital of 5% per annum, and then the projected ROI for that capital, the return on investment is projected at 15% plus on an average per annum, and that's over our 10-year projection. We're going to look at the details in a second. For that capital, this partner will also own equity. There will be equity shares growth. The equity is in the form of 20% shares in the company. That's the company that will own the property, right? And for a period of a minimum of 10 years, 10 years plus, right? So as I said, there are 3 main partners. This is the one. The other 2 partners, one of them would be a surety partner. So that is an individual that has a good affordability with the banks and who can stand surety for a bond of the 1.45 million. That's the asking price for the property. Not the asking price, that's the purchase price, sorry. That surety partner would, in their capacity, own 20% shares in the company as well. And then the Profusion executive members, as a team, they would own 60% shares in the company. So that's the executive summary. Now looking at the property itself, there we have the, I don't want to say it's the curbside view. We were just inside the palisade gates there. But that's the front view of the property. The address is 51 9th Avenue in Belmont Park. And then very brief description, we're looking at a full 3-bedroom, 1.5-bedroom main house. We're looking at a 2-bedroom flat. We're looking at a 1-bedroom flat, and we're looking at a bachelor unit. So we're also looking at a total of 4 rental units. Right. The F size is just below 500 at 496, and the strategy is absolutely multi-let. Delving into the numbers, this is our overview, starting at the purchase price of 1.45, estimated market value of just over 1.5, and we'll have a look at some details where we get that estimation. Then rental income, a total of 26,000. So that's that 4 rental units added together. That gives you a gross yield of 21.5% and an ROI of 10.9%. Just looking at the deal itself. Then capital required 560. Bond affordability required 1.45. The renovations we estimating at 340,000, and then cash flow per month just over 5k. Right. Now delving into the numbers in terms of our monthly cash flow, we're starting with that rental income of 26,000. Then we have the bond repayments, the municipal account, insurance for the building insurance, then rental management, voids and maintenance. Just for clarification, voids is if we have one unit empty, then we have some buffer that we can cover all the costs. Okay, maintenance budget, we're putting away monthly bit by bit so that when we have something that breaks, a geyser bursts, that will be covered by insurance, but we still need that excess paid, or we need to do gutters after a year or 3 or whatever. That's what the maintenance budget is for. Then on honorarium, that's 10% of the rental income. Honorarium is just a legal term, I think a legal term, or it's a finance term. But in any case, that is a fee paid to the directors of the company for managing this business, right? Then the capital partner monthly interest, as we mentioned, that 560,000 capital would earn an interest of 5% per annum. That's where that 2,333 comes from. And then there's a net cash flow of just over 100 Rand. So it looks like this deal is breaking even. But remember, if I just go back a second, if it was an individual buying this property as an investment, that individual is putting in the capital, that individual is getting a bond of 1.45, it means that this deal is cash flowing just over 5,000. But now, since we are running this as a creative finance deal involving the Stokvel, involving a surety partner, and everything that is involved with that, we are just over break even. And remember, that's just for the first year. After the first year, the rentals will go up, everything will go up. We're going to look at some projections in a second. Right. So when we break it down per partner, we're first looking at the capital partner again. This could be the Stokvel. If we can raise all the capital within the Stokvel, and I think there, I also want to just pause for a second. There's an option here. If we do not raise all the capital from within the Stokvel, let's say to keep it simple, we raise half of the capital. We raise, what's that, 280,000 from within the Stokvel. Then the Stokvel would be a capital partner owning 10% shares in the business, in the company, right? And then if we have an individual, a person that would like to join us in this deal, that would like to put down that other half, that other 280,000, that person in his capacity would also be a capital partner owning the other 10%. So you can imagine how you can make that work. I think for keeping the deal structure as simple as possible, the executive members had a chat just before this session that we would like to have a minimum of 200k if we do have that individual that wants to, in his personal capacity, be a partner at a shareholders level, and then all the other members that wants to contribute, they would be partners in the deal, but as Stokvel members at that level. Right. I hope that makes sense. We can revisit that if you like. Okay. So getting back to my example where the Stokvel raises all the capital, right? 560. We mentioned 5% interest. That's a fixed interest rate on the capital, and 20% shares. So delving into that a bit, we've mentioned these first two lines. Repayment. So we're paying interest monthly and capital payable at the end of the loan period. Right. We're looking at 10 years plus. We're looking at 20% shares in the company. And this capital partner's sole responsibility is just to provide capital, right? It's one of those instances where someone provides the cash and they don't have to do anything else, right? So benefits in that role is they own shares in the company. There's equity shares growth, and you also have the fixed monthly interest repayment. The risk is there is joint risk in the business based on shareholding, right? And then the security mechanisms in place, parties sign a loan agreement, so there would be a loan agreement for this capital. Parties sign a shareholders agreement, which also serves as a joint venture agreement. And you also own equity in the company. And the asset, which is the property, is in that company, so you own equity in the asset, right? Moving to that second partner, which is the bond surety partner. We're looking for bond surety of 1.45 million, also earning 20% shares in the company. And delving into that a bit, so that partner's sole roles and responsibilities is to apply for the bond and to stand surety for the bond. That's it. Bit of paperwork. The investment term, that would be for the duration of the bond, that's the 20 years. And then the benefits is own shares in the company and equity shares growth as well. The risk, similar to the first partner, there's joint risk in the business based on the shareholding. And the security, again, the parties sign a shareholders agreement, which also serves as the joint venture agreement, and they own equity in the company, which means they own equity in the property, in the asset. Right. This is our equity projection. This is a slide that I tried to distill just to give you an idea. So I don't have all the years in here. I have every second year, and just the really important lines, because I'm sure if any of you have evaluated a property deal before, it's hectic spreadsheet with loads of numbers, and to show you something in this short period of time is very hard. Anyway, this is a distilled version. So in the top row, we have the market value. So we are estimating that after we've renovated and we've tenanted the property, we're starting at a market value of 1.7, and that would go up, assuming an average capital growth of 8%. Right. And I'm going to get to how we get to the 8%. We're also assuming an 8% average rental growth. I'm going to show you how we get to that. We're assuming a 5% average inflation. And for these numbers, we are assuming that the net cash flow is paid back into the bond. Right. So over the 10 years, that's how the market value grows up until 3.6 million. The remaining bond decreases over the years, which has our equity increase. And then those two partners that we've looked at, the capital partner only 20% and the surety partner only 20%. This is their equity in the deal. So as the years tick by, their equity portion, their shares in the company is worth more and more and more. Bringing this into perspective, if we were to sell the property at year 10, then the capital partner would get their initial capital back, that 560,000, they would get that back. And they would also get this, let's say, just shy of 600,000. So that's the growth of their capital. And then looking at the surety partner, remember that surety partner didn't put any capital in. That person didn't put any money in. They just signed some bond papers, and they had good affordability, of course. They're walking away with just shy of 600,000. So this is the equity growth in the deal with these assumptions. Right. Now I want to just quickly touch on the third partner, and that's the Profusion Stokvel executive members. So the members are bringing the deal to the table. They're bringing the expertise to the table in terms of previous property experience, in terms of bringing their power team along, in terms of things like tax and commercial law and structuring, all those things. And of course, running the Stokvel. Since we started, I think we launched in March, doing all the things that we need to do to start and grow and build the Stokvel. Those executive members aren't earning any monthly salary or any remuneration for doing that. So that's where the Stokvel deals come in in the sense of there's 60%, right? So the benefits for them is they own shares in the company and the monthly honorarium. Risk is also the same as all the other members. They have a joint risk in the business based on the shareholding. Security, we also sign the shareholders agreement and have equity in the company. And then the roles and responsibilities, not only is it to get this deal up and running, but to keep running this deal on a monthly basis going forward in terms of everything, in terms of administration, letting, legal, accounting, tax, doing the renovations and conversions at the start, as well as ongoing maintenance. Just a few bullet points there. Right, so back to the property. So here we're going to look at the individual units. I'm going to give you an idea, right? So here's a few photos of the 3-bedroom, 1.5 bathroom house. It's about 100 squares. It's in very good condition. We're planning to do just some minor aesthetic work, and that's even something we could do at a later stage. Nothing major. Maybe some exterior painting. You can see it's a nice family home. These owners have really been taking care of it. The owner, the husband, is actually a very handy guy himself. Many of the work he's been keeping his hand on it himself. Anyway, carrying on. So this is the current flat that's at the back of the property. It's sorry, that's a typo. This is a 2-bed, 1-bathroom flat, 35 squares. Also very good condition. The owner's son and his wife and their daughter is actually living there. So it's technically also the owner's living there. There we are planning to do a second room conversion. So there is currently 2 rooms. One is a bedroom and one is a storeroom. And we're just converting that storeroom into a second bedroom. So we have a full 2-bedroom apartment, flat. Okay. This is the 3rd unit. We are planning to convert the braai room. On the left, we're looking at the braai room. And on the right, we're looking at half of the living room of the main house. So those 2 rooms, I'm going to show you now on the floor plan. We are converting into a 1-bedroom, 1-bath flat of around 30 squares. And then the last unit, a bachelor flat, converting the current single garage and also taking a bit of that braai room for the bathroom to end up with a 21 square meter bachelor flat. Very comfortable bachelor flat. Right. So this is what the floor plan looks like. The main house is currently this whole section. I'm not sure if you can see I believe you can see my mouse now. This is the main house section over here. This is where the single garage is currently, right? And this is where that 2-bedroom flat is already. It's just that this bedroom closest to the main house, that's a storeroom. So we are converting that storeroom into a bedroom, just putting in a ceiling and I think some tiles and painting the walls, nothing major. Then this single garage, you can see we have allowed there for a bachelor flat, and it's also spilling over into one, let's call it an ensuite bathroom. That's spilling over into the braai room. This whole square is the current braai room, and then the remaining of the braai room plus this portion of the main house living room would be our one bedroom flat with a bathroom over here, right? So the main house is still left with a really spacious living room. It currently has like this 1.5 living rooms, plus it has this really large dining area as well. So there's still loads of space for the main house, for the 3-bedroom house. I just want to mention, if there's any questions along the way, feel free to put up your hand. There'll also be an opportunity at the end for questions. No worries. Okay, so taking a step back from the property and looking at the area as a whole, the town is Kraaifontein. I'm just going to jump to a few points. There we have the average household income. and we're looking at an LSM 9 high, 37% employment. This is now for the bigger town. We're going to delve into the suburb in a second. Right. Looking at the capital growth, looking at the rental yield. I'm delving into the suburb. Here we have Belmont Park. So this house is in Belmont Park. Here we have this a greenhouse. That's actually where the house is situated, where the property is situated that we're looking at. Right. So the household income there in the area between 22 and 33. It's LSM 9 low, 40% employment. This is the distribution in terms of types of properties in the area. Capital growth in the area, the 10-year average for the last 10 years is 13%. So our equity projection, remember, is based on an 8% annual growth. So there we are being quite conservative. The history and the stats says 13%, but we rather under promise and over deliver than doing it the other way around. Right. Rental yield for the area average of 9%. So this is where that data actually comes from. This is a snippet from Lightstone, looking at the median price of the area, and my wife generates this very useful graph at the bottom using these data points from Lightstone, and then getting this straight line. Okay, so these data points in the light blue at the top, that equates to the yellow line going up and down, but as a whole going upwards. And then this straight black line, that is at 13.14%. Right, so that's the 10-year average, looking at the last 10 years. Okay, amenities in the area, relatively close to Kraaifontein train station and taxi rank. Drivers for employment in the area. Again, just for to orientate yourself, this green little house icon, that's where the property is. So the drivers for employment, Kraaifontein industrial is just on the other side of the train line. Brackenfell industrial is here at the bottom, just behind our Profusion logo. Okavango Park is just above that. Right. Shopping centers, all these little trolleys are shopping centers. If you guys have an idea of Cape Town, this one over here is Cape Gate, which is a very big mall, a popular mall in the area. Then schools in the area, all these blue books are schools. You can see many schools. High schools, secondary schools, primary schools, all over the place. Right, so rental performance, this data comes from TPN, which shows a rental yield of 9% average. Okay, rental payment, good standing at just shy of 80%, and a typical rental increase trend of 10% and up. Okay, so this is, again, remember, our projections are looking at an 8% rental increase per year, again, being conservative. The actual data says 10%, so we will obviously push for 10% at the end of every year. But if we need to drop to 8, that's still fine. That's still budgeted for in the numbers. Right. Rental estimates. So for the 3-bedroom house, 100 squares, we'll be charging 12. For the 2-bedroom flat, charging 6. 1-bedroom flat, 4.5. Bachelor unit, 3.5. Okay. Looking at market value, right? So this is what my wife Chanel used to estimate the current market value as well as the market value after we've renovated and tenanted. Okay. So the top property, this solid yellow, that's the property that we are looking at, and all the others are recent sales. And you can see she went for house size estimates that are similar to the one we are looking at. So you can see some of them were sold for slightly less, some of them for more, bringing us at an average of 1.5 million. Okay. Then the next slide, we're taking that same average of at 1.5 at the top, Okay, that's the estimated market value at the current stage. And then the highest recent sale price is almost 1.8, right? If we take our required minimum 16% yield for a property investor to buy this property from us, we could potentially charge 1.95. Okay, but we obviously don't want to price ourselves way out of the market. So looking at the highest sale, 1.78, we're comfortable with an estimated market value of 1.7. Again, after renovations, after we have good tenants in place. Okay. You must have met some of the team already. So on the far left, we have Shellyboy Matiba. He's our chairperson. Myself, Louis Skitakat, as the secretary. We have Lucky Matiba as our treasurer. And my wife, Sunal Skitakat, as our validation officer. And then the power team that is supporting us and that is supporting the deal. We've got all the industries covered. Some of these brands you've seen before. From sourcing, legal, structure and tax, inspection, construction, materials, and management. Everything and then some. So to summarize, the deal on the table is as follows. There are two types of partners. And again, that first capital partner could be the Stokvel as a whole. If we raise the 560, everything from within the Stokvel, from Stokvel members, then there's actually just one capital partner. If we don't raise it all, then we can have a second capital partner as an individual, being a capital partner together with a Stokvel. Okay, so the Stokvel would be a capital partner and that individual would also be a capital partner. We're looking to raise a total of 560, offering a monthly interest on the capital of 5% per annum. Projected ROI of 15% plus. That is based on that monthly interest as well as the equity growth. Remember that equity growth projection that we had from year 0 to year 10. Those two growth elements get you to the 15% ROI. Right. For that capital, you get equity shares growth. You get 20% shares in the company, and looking at a period of 10 years plus. So we're really looking medium to long term with this deal. Then the second kind of partner is a surety partner, standing surety for 1.45 million. That is the purchase price, and that partner also owns 20% shares in the company. So that's the summary. We have a bit of fine print. I'm sure you've seen this kind of fine print on other Stokvels and other property investment platforms. Basically, this just says that we try our ultimate very best to provide as accurate information as possible. And we cannot be held liable if there are any inaccuracies or any incompleteness. Okay. That's it. Thank you very much. I want to keep it on the summary slide, and then open up for any questions that you may have.
Thank you, Louis. Guys, thank you so much for joining. I see some of you guys have joined late. So what are we gonna do? We're gonna make the recording available once it's available. Yeah, as Louis said, for those who have questions, you can go ahead and Louis will be able to answer them. And also I see Sunel is here also.
Shellyboy, maybe I can just I don't want to summarize because we already have a summary. Maybe just tie up the presentation in the sense that from a bigger picture point of view, from a Stokvel point of view, from a deal point of view. So this deal is on the table. The Stokvel has first priority or first option to enter into the deal. So as Stokvel members, each individual Stokvel member can now decide, yes, they want to join the deal, putting their capital that they've already invested in the Stokvel. Remember, those funds are still yours. So if you put up your hand, then you could join the deal, putting that capital as a Stokvel member into the deal. There's still an opportunity if you want to add more capital in your Stokvel account, to be able to invest more into the deal. Remember, while I'm saying that the Stokvel partner is the Stokvel is a capital partner, as an entity. If the Stokvel raises 560 and owns 20% shares, let's just take an example, and you as an individual Stokvel member, you've invested, I'm going to try and keep it simple, you've invested 56,000 into the Stokvel, right? And you want to put that capital into the deal. That's 10% of the total required capital, right? So then you'll own 2% equity in the property. That makes sense. So as the Stokvel members, as a pool of Stokvel members, the Stokvel is joining the deal as a partner with X capital, but the individual members, depending on how much funds they've contributed, that's their equity portion. Hope that makes sense.
Louis, thank you for that, because I actually was just about to ask that, but you cleared it up nicely. So I think for now then things are pretty clear.
Okay, that's excellent. Good to hear that. Thanks, Donovan. So if there are no further questions, surely, boys, should we haven't discussed this yet, but should maybe be a case of, okay, there's a decision period where members can still decide. We obviously want to get this presentation recording out to all the members so that everyone has an opportunity to look at the deal and to ask their question and to put up their hand and say, yes, I want in. But obviously, any deal is time sensitive. We put it that way.
Yeah, fair enough. So maybe, I don't know, by end of the week or latest, or Thursday latest, people should have applied their mind, and then we take it from there.
Sounds good. Sounds good. These members that have joined us, do you feel comfortable with a period of till Thursday, Friday? Do you maybe want the weekend as well? Worst case, maybe just as a few from the members.
Yeah, to me it sounds reasonable. I mean, that means you have practically a working week to think about it. So I mean, to be honest, by Friday, I think we should all be able to decide.
Okay, good stuff.
Agreed.
Okay, thanks, guys. Thanks for that.
Okay, I think that's about it. Thank you so much, guys, for joining us and being patient with us. We'll make the recording available to you as promised, and then we take it from there. Thank you.
Good stuff. Thanks, guys. Have a good evening.
Thank you very much.
Thank you. Cheers.
Good evening. Cheers.